Imagine this, you walk into a bank, open a savings account, and feel responsible. Smart, even, you're doing what your parents told you to do. What every financial expert recommends. You're saving money. But here's what nobody tells you. That moment, right there, is exactly when the bank starts making the most money off you. Not when you take out a loan, not when you overdraft, when you save. I know what you're thinking, that doesn't make sense. Savings accounts are supposed to help you. They're safe, they're boring, they're profitable, just not for you. Stay with me, because what I'm about to show you will completely change how you see every bank in America. And it all starts with a crisis most people have forgotten, a regulatory loophole that was supposed to protect you, and a mathematical trick that's been hiding in plain sight for over 40 years. To understand how we got here, we need to go back to 1980. Jimmy Carter is president. Inflation is crushing the middle class at rates we haven't seen since. And American banks are dying, not metaphorically, actually dying. Between 1980 and 1994, over 1,600 banks failed in the United States. Savings and loan institutions, those neighborhood banks your grandparents trusted, were collapsing at a rate of one every 3 days. The governance solution? The Depository Institutions Deregulation and Monetary Control Act of 1980, a mouthful of a name that promised to save American banking by removing interest rate caps and allowing banks to compete for your deposits. Sounds good, right? Free market competition. Banks fighting for your business. But here's where the story takes its first turn. Because what actually happened was the opposite of competition. What happened was the creation of the most sophisticated wealth extraction system in modern finance. And it worked precisely because it made you feel like you were winning. Let me explain. Before 1980, banks were boring, regulated, limited in what they could pay you and what they could charge borrowers. The spread, the difference between what they paid depositors and what they earned on loans, was controlled. Banks made steady, predictable profits. Nothing spectacular, nothing dangerous. Then deregulation hit, and suddenly banks could do something remarkable. They could pay you almost nothing on your savings while charging astronomical rates on their loans. The spread exploded from around 3% to over 6%. Then 8, then double digits. But wait, you're thinking, wouldn't people just move their money to wherever paid the most interest? That's the logical assumption. That's what economists predicted. That's what was supposed to happen. It didn't. What happened instead reveals something fascinating about human psychology and financial systems. Banks discovered they could advertise savings accounts as safety and responsibility while simultaneously engineering those accounts to transfer wealth from depositors to shareholders. And they could do it completely legally with your enthusiastic participation. Here's how the system works and why it's so profitable. When you deposit $1,000 into a savings account earning 0.5% interest, you're making $5 a year. Feels like something, right? Better than nothing. Meanwhile, that same $1,000, your $1,000, becomes part of the bank's reserve. Under fractional reserve banking, the bank can lend out approximately $900 of your deposit. Now here's where the math gets interesting. That $900 gets loaned out for a car loan at 7% interest, or a personal loan at 12%, or a credit card balance at 24%. Let's use the conservative number, 7%. The bank makes $63 annually on money you deposited. You make $5. The bank makes $58 on your savings. But it gets better for them, worse for you. Because banks realized something crucial in the 1980s and 90s. Most people don't do this math. Most people see savings account and feel financially responsible. They see any interest rate, even 0.01%, and think free money. They compare savings accounts to cash under their mattress, not to what the bank is doing with their money. This psychological blind spot created what I call the responsibility trap. The more responsible you tried to be with money, the more wealth you transferred to financial institutions. By the mid-1990s, this system had matured into something extraordinary. The top 10 banks in America held 26% of total deposits. Today, over 50%. They've consolidated power precisely by convincing people that parking money in savings accounts is smart financial planning. But the real genius, the part that makes this system nearly unbreakable, came from what happened after 2008. The 2008 financial crisis should have changed everything. Banks had gambled with deposits, created toxic assets, crashed the global economy. Surely the punishment would be severe. Surely the system would be reformed. Instead, something remarkable happened. The Federal Reserve, in an attempt to save the economy, dropped interest rates to near zero, and they kept them there for over a decade. Think about what this means for our equation. Banks could now borrow money at essentially 0%. The federal funds rate, the rate banks charge each other for overnight loans, dropped to 0.25%. Some institutions could access Fed money at literally 0%. Meanwhile, what happened to the rates banks paid on savings accounts? They dropped to 0.01%, to 0.05%. Some banks offered 0.00%, literally nothing. But here's the crucial part. Loan rates didn't drop proportionally. Credit cards still charged 16 to 24%. Auto loans still ran for 7%. Mortgages, even at historic lows, were 3 to 4%. The spread, that difference between what banks pay for money and what they charge for money, didn't shrink, it exploded. Let me give you the numbers that banks don't advertise. In 2010, the average savings account rate was 0.14%. The average credit card APR was 16.87%. That's a spread of 16.73 percentage points. In 1990, when savings accounts paid 5.84% and credit cards charged 18.17%, the spread was 12.33 percentage points. The crisis made it worse. Banks were getting essentially free money from the Federal Reserve and from depositors who still believed savings accounts were responsible financial planning. They were lending it out at rates that, while lower than historical highs, were stratospheric compared to their cost of capital. JP Morgan Chase reported a net interest margin, that's the profitability of their lending versus their cost of funds, up to 0.39% in 2019. Doesn't sound like much until you realize they had $1.6 trillion in deposits. That's $38 billion in profit from the spread alone. Bank of America to 0.6% margin on $1.4 trillion in deposits. Another $31 billion. These numbers, these profits, came directly from the pockets of people who thought they were being financially responsible by keeping money in savings accounts. By 2020, something remarkable had happened to American wealth distribution. The median American savings account held $5,300, earning 0.06% annually. That's $3.18 per year. Meanwhile, the median American credit card debt was $2,700 at 16% interest. That's $432 annually in interest charges. Notice something? Many Americans were simultaneously keeping money in savings earning nothing, carrying credit card debt costing hundreds per year, feeling responsible about the first, feeling guilty about the second. This is not an accident. This is not financial illiteracy. This is the system working exactly as designed. Banks had successfully created a paradigm where emergency funds in savings accounts were considered responsible, even as those same funds earned less than inflation. Between 2010 and 2020, inflation averaged 1.7% annually. Your 0.06% savings account was losing 1.64% of purchasing power every year. Your savings was shrinking in real terms while the bank used it to generate profits at margins not seen since the 1980s. But the story gets darker when you look at who this system hurt most. Lower-income Americans, the people who couldn't afford financial advisors or complex investment strategies, kept disproportionate amounts of wealth in savings accounts. A 2019 Federal Reserve study found that families in the bottom 50% of income kept 64% of their financial assets in transaction and savings accounts. The top 10%, only 8%. The wealth transfer was regressive. The people who could least afford to subsidize bank profits were subsidizing them the most. After 2008, regulators promised reform. The Dodd-Frank Wall Street Reform Act, thousands of pages of regulations designed to prevent another crisis and protect consumers. Did it address the savings account wealth transfer? Barely. The Consumer Financial Protection Bureau was created to protect consumers from predatory financial practices. They cracked down on overdraft fees. They improved mortgage disclosures. They went after payday lenders. But the core mechanism, the system by which banks pay depositors almost nothing while earning massive spreads on loans, remained untouched. Why? Because it's not illegal. It's not even hidden. It's just never explained in terms people understand. Banks will tell you they're offering competitive rates, and technically they are. Competitive with other banks offering equally terrible rates. It's a race to the bottom where everyone loses except the institutions. Some online banks tried to disrupt this model. Ally Bank, Marcus by Goldman Sachs, various credit unions offered savings rates of 1 to 2% in the late 2010s. Real competition, finally. But here's what happened. Most people didn't move their money. Despite massive advertising campaigns, despite rates 20 to 40 times higher than traditional banks, the vast majority of savings stayed with the big institutions paying almost nothing. Why? Inertia, brand trust. The psychological comfort of that brick-and-mortar bank your family has used for generations. The hassle of switching. Banks had successfully made the wealth transfer so comfortable, so normalized, that people wouldn't leave even when significantly better options emerged. The Federal Reserve noticed this too. In research papers, they documented deposit stickiness, the phenomenon where depositors don't move money even when rates elsewhere are dramatically better. This stickiness, they noted, gives banks significant pricing power. Translation: banks can pay you almost nothing because they've correctly calculated that you won't leave. Now, let's fast forward to today. 2024 and 2025, surely things have changed. They have. They've gotten worse. In 2022 and 2023, the Federal Reserve raised interest rates at the fastest pace in 40 years. Fighting inflation that hit levels not seen since the 1980s, the Fed funds rate went from 0.5% to over 5% in less than 18 months. What happened to savings account rates? They increased to 0.4%. Maybe 0.5% at major banks. What happened to loan rates? Credit cards shot to an average of 22 to 24%. Auto loans jumped to 7 to 9%. Mortgages hit 7 to 8%. The spread didn't just widen, it became a chasm. Banks are currently enjoying some of the most profitable lending environment in modern history, not because the economy is booming, because the gap between what they pay for money and what they charge for money has never been larger. Let me put this in concrete terms. If you have $10,000 in a Chase savings account earning 0.01%, you make $1 per year. Chase can lend 90% of that deposit, $9,000. On a credit card at 23% APR, they make $2,070 annually. On your money, well, you make $1. That's a $2,070-to-1 profit ratio on your deposit. Meanwhile, inflation in 2022 was 6.5%. In 2023, 3.4%. Your $10,000 lost hundreds of dollars in purchasing power while earning $1 in interest. The bank made over 2,000. And here's the pattern that keeps repeating. Every crisis, every intervention, every reform makes this system stronger, not weaker. The 2008 crisis led to lower rates for depositors and maintained spreads for banks. The 2020 pandemic, same result. The 2022 to 2023 rate hikes record bank profits while savers barely budged. Recent data shows that in Q3 2023, America's largest banks posted combined profits of over $60 billion. A significant portion came from net interest income, the spread between deposits and loans. This isn't a bug in the system, this is the system. So what do we learn from this? First takeaway, financial institutions profit most from behaviors they've taught you are responsible. Keeping large sums in savings accounts, maintaining emergency funds at brick-and-mortar banks, trusting that established institutions have your best interests at heart. These behaviors, marketed as financial wisdom, are actually wealth transfer mechanisms. The responsible thing you think you're doing? It's exactly what keeps the system profitable for everyone except you. Second takeaway, regulatory capture means reforms rarely address core profit mechanisms. Regulators focused on the dramatic failures, the risky baits that cause crashes. They ignored the slow, steady, legal extraction of wealth through deposit spreads because it's boring. It doesn't cause crises, it just quietly transfers trillions of dollars over decades. The reforms you hear about, they're theater. The real money-making mechanisms remain untouched. Third takeaway, financial literacy isn't enough when the system itself is designed to exploit rational behavior. You can understand every word of this video and still face the same choice. Keep money somewhere accessible and safe, losing purchasing power, or take on risk and complexity beyond what most people can manage. The game is rigged not through deception, but through structure. You're not failing to play the game correctly, the game itself is the problem. Here's the question I want to leave you with. If banks profit most when you think you're saving money, and the system designed to make you feel responsible for behaviors that transfer your wealth to institutions, what does actual financial responsibility look like? I don't have a complete answer. Nobody does. Because the answer requires changing a system that every powerful institution benefits from maintaining. But I know it starts with seeing the system clearly. Understanding that the gap between what you're told is responsible and what actually preserves your wealth keeps growing. Understanding that every dollar sitting in a 0.01% savings account is a dollar actively working against your financial future while working for someone else's quarterly earnings report. The banks aren't going to change this. The regulators haven't changed this. The question is whether enough people understanding how this works will eventually demand something different. Because right now, the most profitable customer for any bank is the one who thinks they're being financially responsible while quietly subsidizing record profits. If this video changed how you see banking and personal finance, share it with someone who still thinks their savings account is helping them build wealth. Subscribe for more deep dives into the financial systems that shape our lives in ways we rarely see. And maybe, just maybe, check what interest rate you're actually earning. Then check what your bank is earning with your money. The difference, that's their profit margin. On your financial responsibility.